Hi, my name's Steve Walker from Promise Money, and today I'm going to tell you about some potentially misleading high-cost commercial loans. Now, I'm not saying that these are bad loans. What I am saying is they're not going to suit everybody, and they probably only represent a very, very small percentage of the market. But what you've got to be careful of is that you don't end up with one of these loans without knowing how it works. And the reason I say that is if you were to go on Google and search for commercial loans, or if you're a broker, you might have somebody coming to you and saying, right, I need a commercial loan, and you could well get offered a loan of this nature. So just to give you a little bit of background, let me put this in context for you. So we have tier one lenders. There's around half a dozen active lenders in tier one. They tend to be banks. They tend to offer great rates. They prefer owner-occupied commercial premises rather than investment properties generally, and they're looking for borrowers with a good track record, good credit history, and they apply more stringent affordability criteria. So they're taking the cream off the top. They're cherry-picking the best cases. They're less keen on investment properties, as I said, but they're going to offer the best rates. Then we have the tier two lenders, and there's 3 or 4 of these currently active in the market, and they'll try to pick up the applicants who maybe don't quite fit for tier one. Due to affordability, or maybe the property type or the sector, but they still offer pretty decent rates and great lenders too. Then we have tier 3, and there's a good choice of lenders in tier 3, and they'll look to accommodate particular niches. It could be around affordability, it could be the property type, it could be the experience of the borrower, and these lenders tend to be a little bit more relaxed, where the income is coming from retail premises, rental income from retail premises or from offices, and they'll pick up a lot of business which falls out of tier 1 and tier 2. But as a potential commercial loan borrower, don't make an assumption that you fit into a particular category, because we will always try to find out your circumstances, fully understand what it is you're looking for, and if we can get you from tier 3 to tier 1, well, that's what we'll do. But today I want to talk to you what I refer to as tier 4, and these are lenders who are on the edge of commercial lending, and they offer loans when others won't. They'll accept bad credit. They'll accept applications which involve a high degree of income protections. They'll even look at startup businesses. So if there's sufficient equity in the property or the security that's being offered, they'll go to great lengths to try and accept the application. And you might even see adverts, 95% acceptance rates. So that's great news for many borrowers, but they need to know what they're getting into. So firstly, a main difference here is they'll often quote flat rates rather than APRs. Now, with an APR, the interest is charged on the balance as it reduces. So as your loan balance is coming down like this, the interest is charged at the balance at the time. So it averages out and gives you an APR over the term of the loan. With a flat rate loan, all of the interest is added on at the start. So the interest you pay in the final year is going to be the same as the interest you pay in the first year. So whilst the rates may sound the same in a conversation with a lender or on the documents, the flat rate is going to cost you roughly double the APR in most cases. So you could pay double the amount of interest. Let me give you some examples. So let's take a traditional £100,000 commercial loan at 4% over 10 years. Okay, so we've got 100,000, 4% times 120 months. Okay, now that would cost you on a traditional loan round about £1,010 per month. Okay. So that's a total repayable, multiply that by that, that's a total repayable of £121,000, give or take. So your cost of credit is roughly £21,000. That's the amount you will pay in interest over the term of the loan over 10 years, £21,000. So let's now compare that to a flat rate loan. Well, on a flat rate loan, your £100,000, you're going to get charged 4% interest per annum. So in year 1, 4%, £4,000. Okay, it's a 10-year loan, so it's 10 times £4,000. So that's a total of £40,000. Okay, £40,000 versus £21,000. Now the repayment on that I've worked out roughly to be around about £1,166 per month versus £1,010 a month. That's not a huge difference, but £19,000 or thereabouts difference in interest over the term of the loan is a massive difference in interest. So that's the first thing you've got to take into consideration. Now the big difference on these loans, as well as paying £18,000 or £19,000 extra on interest over the term of the loan, is how the early repayment charges are calculated. On a traditional commercial loan, this will be made fairly clear to you at the outset, and you could be charged an early repayment charge of say 2%. Okay, so that's 2% of the loan balance at the time. On flat rate loans, they work a lot like car finance or a lease agreement. And if you ask some lenders if there's early repayment charges, they'll proudly tell you there aren't. That's because you have to pay the full amount of interest under the agreement for the term. So if you settle early, no, there won't be an early repayment charge, just pay us everything. So let's put this in context. Just for illustration purposes, these are rough figures. On our traditional commercial mortgage, we're borrowing £100,000 over 10 years at 4% with a repayment of £1,010 per month. After 2 years, we decide we want to settle it. It's a straightforward calculation. And let's say for this example, there's a 2% ERC. I should point out that with most high street lenders, there are no ERCs, but for some of the specialist lenders there are, and they vary. So let's say there's a 2% ERC on 84,000, which is what the balance is roughly going to have dropped to on a £100,000 loan if you paid 2 years off. So we've got £84,000 balance, 2% of that, £1,700. Add the two together, you're going to pay back £85,700. That's not too bad at all. Now let's take the flat rate example. Remember, it was front loaded with interest, so you've borrowed £140,000 over 10 years at 4%, and your repayments are £1,166. Okay. After 2 years, you say you want to settle the loan, and the lender says, well, you can settle the loan, but you've still got to pay everything underneath the contract, which means you've got to pay 96 remaining payments of £1,166, which is £112,000 there or thereabouts. Okay, so instead of paying that, you're paying that, and that's a difference of £26,236 extra you've paid for settling early on this type of loan. But let's also not forget that whilst you had the loan for 2 years, you were paying that instead of that. Now that, I believe, difference between that and that is £156, which you paid for 24 months. Okay, which is, I'm not working this out in my head, I have calculated it earlier, 3,744. So you've got that figure and you've got that figure. Let's call it £30,000 on your £100,000 loan. Because you didn't read the small print, or because somebody didn't tell you exactly what you were getting into, you've ended up paying an extra £30,000 in ERCs and interest. I think it's important for people to know that. So there we go. Now, what I will say is that this doesn't make it a bad loan, because if you keep the loan for the whole term, yes, you're going to pay more for it, but that might not be the only loan that's available to you. You might have a new start business. You might have some adverse credit. You're using this to get the business going or get it back on its feet. Take it over a short term and don't pay it off early. Use it as a tool. It is a valuable tool for some borrowers, but not for that many. So it's not a bad loan, it's just not as good as others that are out there. The important thing is know what you're getting into. Know whether you're working in flat rate, know whether you're working in an APR. If you're talking to high street lenders, and most of the tier 2 lenders and tier 3 lenders, they will be working on normal APRs. But your broker must tell you what you're getting into. Okay, so it's not a bad loan, it's just not the best there is. And if you are going to take it out, work on the basis you're going to keep it for the full term. That's what I would say, because whilst the lenders will say, oh, we'll give you a little bit of rebate on that, it's probably going to be 3 or 4%. So it's a round of drinks in the whole scenario. These sort of agreements you'll be familiar with because they're very common for car finance. They're very common when you buy a photocopier on finance. It's that sort of agreement. The key thing is, don't get caught out, understand what you're getting into. So I hope you found that useful. Please subscribe to our other videos, have a look at those. There's plenty of other videos on commercial finance, on bridging finance, on all sorts of different topics, which I hope you'll find useful. Sign up to our emails and you'll find details at the bottom of this video or on our website. So thanks very much, and I hope this was useful to you.